Hi there, welcome to Kneppy Invest. In today's video, I'm going to talk about Credit Corp Group. This is a company I'm fairly indifferent to. I sort of can understand why people might get excited about this company, particularly right now. It does look like it could be undervalued, and that actually makes sense because when we look at the long-term chart for Credit Corp, this company gets absolutely slammed during recessions or downturns in the economy. It happened during the GFC, and it also happened during the COVID-19 financial panic. And we have seen another significant drop in the share price over the past year. So now could be an attractive time to take a position in this company if you do like what Credit Corp does. And Credit Corp is a debt collector. They call themselves a debt buyer and a debt collector. And one thing I didn't know they do, they're also a lender. So I went to their annual report, and in their consumer lending business, they provide the cheapest and most sustainable loan products to consumers who have limited borrowing alternatives. That does seem there's a fair bit of risk in doing that. I've also heard or read somewhere that they have acquired Radio Rentals. I believe Radio Rentals was a company owned by Thorn Group. So this company is a little bit more diversified than I thought. I thought Credit Corp was all about debt collecting, and debt collecting is their biggest side of the business. Particularly, I'm going to guess here, but I'm going to say particularly in the United States. But they are growing in the United States. This is not just an Australian debt collecting company, and it does sort of make sense why this company could find it difficult during the tough times because people are probably less willing um, to pay back their debts when times are tough. But on the flip side, when we come out of recessions and people start getting jobs and they're more able to buy their or pay back their debts, it would make sense that Credit Corp would be going through some really good times. So maybe now is a time to take a closer look at this company because the share price has dropped by about 50% over the past year, and the valuation of this company does look quite attractive. First question I always want to ask in regards to a company is whether it is high or low quality. And this might be really important to Credit Corp right now because if I thought Credit Corp was a high quality company, the value right now looks pretty intriguing. And this is even after November 11 when the share price rose 10%. And I think the PE ratio was just over 11 at the start of trading on Friday, the 11th of November. Now it's about 13 or something like that. So even at 13, this company and its valuation looks attractive, even when you compare to the typical PE ratio this company has. Now, typically the PE ratio of Credit Corp is in the teens, but most of the time, over the past 10 to 12 years, the PE ratio has been between about 15 and 20. So right now, less than 15 means this company is attractive just based on valuation if you do consider this company to be high quality. Now, if you thought this company was low quality, it all comes back to the trend in the share price. The value doesn't matter quite as much. And the trend is down with the share price, even though share price did increase 10% on Friday. But we'll have a look at the charts during this video. We'll have a look at the weekly chart first, and then that's at the start of the video. And then at the end of the video, we'll look at the daily chart. Now, for full disclosure purposes, I am not a shareholder of this company. I have never been a shareholder of this company. It's just not the sort of company that really entices me, excites me, that sort of thing. Debt collecting is just not something that tickles my fancy. And that's the main reason I've never taken a position in this company. However, in saying that, I'm trying to broaden my horizons, trying to broaden the companies I'm willing to take an investment in. And Credit Corp definitely fits in with that within that group. And particularly because of the valuation right now. So if I hadn't done this video, I probably wouldn't have taken a second look at this company. But because I've done this video, looked at the valuation, and noticed the share price has taken a significant dive because of fears of us going to recession, not only us, but the United States going to recession, and Credit Corp could be negatively affected by those difficult times, I think that has given us an opportunity to buy this company at really good valuations. So that has given me a little bit of pause, and I am willing to do a little bit more research on this company moving forward. Now, I am debating with myself whether this is a high quality or low quality company. And one of the tricks I have found is all you have to do is look at the weekly chart, and that can make the decision for you. And when we do look at the Credit Corp Group's chart, this is the weekly chart going back to 2012, so 10-year chart here. This has the characteristics of a high quality company unless something is happening in the macro environment. Because between about 2012 and just before COVID-19 financial panic, this was a brilliant looking chart. Share price increased from about $6 to a high of $38. So this was a six bagger during that time. Well-defined downtrend, and that is the sort of chart you want to see for a high quality company. However, during COVID-19 financial panic, the market panicked in regards to this company, and the share price fell from $38 to a low of about $6. So that $6 was the same share price back in 2012 at the start of that uptrend in the share price, so 10 years ago. And then we had that V-shaped recovery in the overall market and in Credit Corp share price. But share price didn't get back up to those pre-COVID highs. It went up to about $36. And since that high, which was at the beginning of 2022, so the top of the market, we have seen the share price of this company halve. It's actually gone down from $36 all the way down to a low of about $16.50, so more than half. However, in the last week or so, the share price has rebounded, actually the last 3 weeks, share price has rebounded to above $20. So just based off the chart between 2012 and 2020 or January 2020, that really looks like a high quality company chart. But since then, a lot of volatility that is telling me this is a cyclical company or has the characteristics of a cyclical company. And I would categorize the majority of cyclical companies as being low quality companies. And just to further emphasize that argument I am having, this is the weekly chart for the company between 2001 and 2011. And during those really good times before the GFC, so between about 2003 and 2008, this was an absolutely brilliant holding in your portfolio if you were a shareholder, because the share price went from about 50 cents to a high of $12 or actually $13. So this was a 26 bagger for those who held during a 4-year period. And then the GFC happened, and you can see what happened to the share price. Share price of this company fell from $13 all the way back to 50 cents. Not only that, it fell rapidly. And there were 2 really bad weeks in here where the share price fell over 50%. In fact, there was one day in 2008 where the share price fell 75% in one day. And no doubt that was on the back of really negative news from the company. So just by looking at the very long-term chart, 20 years of history, that tells me that the time not to own this company is during difficult times in the economy. And because of that, I'm still leaning towards arguing that this is a cyclical company, which means you only own this company during the good times when the share price is in an uptrend. So that is my thoughts, my thinking right now. Now on to the financial year 22 results for Credit Corp. I did have to change some numbers here because the share price rose $2, 10% on Friday the 11th of November. I set up this video, or the slides in this video, about the 10th or 9th of November. So I had to change a few numbers here. But the share price did close at $20.35. Now have a look at the share price if you're watching this video, because probably more than likely we'll release this video after trading has finished on the 14th of November. And I do expect another pretty good day on the ASX, and more than likely Credit Corp share price will be a little bit higher than $20.35. It may not be, might be lower, who knows. But at $20.35, the market cap of this company is $1.4 billion. Now on to the financial year 22 numbers. Revenue, $411.2 million. Profit, now underlying profit. So there was a statutory profit or reported profit and an underlying profit. Underlying profit, $96.2 million. We're going to use that because that I would probably define that as the real profit. Now, this company was not operating cash flow or free cash flow positive. In fact, Credit Corp was operating cash flow negative by $107.6 million and free cash flow negative by $111.4 million. So that is what we're going to explore during this video. Why was this company highly operating cash flow and free cash flow negative? Now, one other way I use to determine whether a company is high quality or low quality, apart from looking at the long-term chart, is just the revenue growth. You probably also could look at profit growth, operating cash flow growth, but they tend to be a little bit more volatile. Revenue for high quality companies should be going up through time. It doesn't always have to go up from year to year, but you want to see an uptrend, a definite uptrend there. And this is Credit Corp's growth or revenue growth since 2012. And there's definitely some growth there in revenue from 123.6 million to 406 million. Now, this company has issued quite a few shares over the past 10 years. So I like to look at revenue per share growth. And when you do look at revenue per share growth, it's not quite as attractive. Now, over the past 10 years, revenue per share has grown at 7% per year. But over the last 5 years, we have a negative number. So negative 1.3% growth in revenue per share. And over the last 3 years, that number is negative 3.5%. So even though revenue has grown during the last 5 years, the company has issued shares, so revenue per share have actually dropped. Now, I mentioned in the previous slide that when you do look at profit or maybe even operating cash flow history, there's a lot of volatility, and that is definitely true for Credit Corp, particularly in their operating cash flow. A lot of volatility, a lot of years where they have significant operating cash flow. 2020, $115.6 million of operating cash flow. 2021, $67.8 million. But there's also some years where they're highly operating cash flow negative, like 2022. $100 million operating cash flow negative. Back in 2016, $62.5 million operating cash flow negative. Now, when you do look at profit, generally profit has been going up apart from 2020, where profit was only 15.5 million. And that also leads to the argument that this company does experience problems during downturns in the economy. And that would have been true for 2020. And that's the reason why profit was really low that particular financial year. Now, let's try to understand why or how this company could be operating cash flow negative by a large amount. So I'm going to look at the cash flow statement in this particular slide, and then we'll have a look at the reconciliation of cash flow to profit, which is note 20 in the next slide. The main things here is I want to understand why it's operating cash flow negative, and we do get answers in this particular slide or this particular cash flow statement. So receipts of customers, $667 million. Now, they also have a cash flows from operating activities before changes in operating assets. And this company was highly operating cash flow before changes in operating assets by 386.7 million, slightly higher than last year where it was 386.0 million. But there's also changes in operating assets arising from cash flow movements. This is in regards to net funding of consumer loans and the acquisition of purchased debt ledgers. So this is Credit Corp going out there and buying debt. And it's really interesting when you do actually go to Credit Corp's website, and I'll try to bring it up somewhere. I'll bring it up. I'll just keep on talking here. If you go to the Credit Corp website, and I should have kept this website up here. It's really interesting what they write or what they mention on their home page. This is what they've mentioned. If you've heard from us, it's likely because Credit Corp has been assigned your account from a bank, finance, telecommunications, or utility company. This means you now owe the outstanding balance to Credit Corp. So what they're virtually saying is you've been a bad boy, you haven't paid down your debt, and now your debt is ours to harass you so you can pay your debt to us. And that is that acquisition of purchased debt ledgers. And in 2022, that was $395 million, only $293 million last year. And that's the reason this company was operating cash flow negative by over $100 million, because they purchased a lot of debt. Not only did they purchase a lot of debt, they provided a lot of consumers loans. In fact, that increased from $25 million last year to $92 million this year. To fund this operating cash outflow, they also borrowed. So they increased the loans by $129 million in financial year 22. Now, we have better clarity on why Credit Corp was operating cash flow negative, highly operating cash flow negative in financial year 22. Now, we can have a look at the reconciliation, note 20, in this particular slide to give us even more clarity, but I'm not sure we really need it. So what the reconciliation is, it goes from the cash flow from operating activities, which is, well, actually goes from the profit, sorry, which was $100.7 million, and then works its way backward to show you how you go from being profitable by $100 million to being operating cash flow negative by over $100 million. And what they're looking at here is stuff like depreciation, amortization, changes in working capital. Those are two things I am mainly looking for. But with Credit Corp Group, the reason why this company was highly operating cash flow negative, as explained in the previous slide, explained by the cash flow statement, is because of changes in consumer loans, receivables, and purchased debt ledgers. There was also a decrease in trade and other payables by $20 million, and trade and other receivables also decreased by 8.3 million. So a decrease in trade and other receivables is actually a cash inflow, not a cash outflow. So those are the reasons why this company was operating cash flow negative by a large amount. Nothing to be concerned with at all, but the company has given us some guidance in regards to what they expect the cash flow will be in financial year 23. So we'll have a look at that later in this video. In fact, we're going to have a look at this now. So this is their guidance for free cash flow instead of operating cash flow. You can just see they've got 4-year history and then a projected free cash flow. And back in 2019, they were free cash flow negative by 3 million. 2020, 38 million free cash flow positive, 65 million free cash flow positive. 2021, over a $100 million free cash flow negative in financial year 22. But this company expects to be free cash flow positive by over $100 million, in fact, $115 million in financial year 23. This is the only company that have provided this sort of guidance. I have seen no other guidance from any other company that has provided some cash flow, free cash flow, operating cash flow guidance for the next financial year. Most companies just provide maybe some revenue guidance, EBITDA guidance, but I love that Credit Corp has provided this information. Another thing I really like to look at when I am analyzing a company's financial statements, particularly if a company has many different segments, is just to see where the revenue is derived, which segment is the biggest segment or division for a company. So Credit Corp has divided their business, their company, into 3 different operating segments: debt ledger purchasing Australia, New Zealand, debt ledger purchasing United States, and consumer lending Australia, New Zealand, and United States. I thought that maybe the debt ledger purchasing in the United States would have been the biggest segment. It's not. It's actually the smallest segment, just slightly behind consumer lending. But by far, the biggest segment is debt ledger purchasing in Australia, New Zealand, $230.2 million of revenue. Debt ledger purchasing in the United States, $87.3 million. And consumer lending, $93.7 million. Now, just below the revenue, they have the segment profit. So we can also see margins. So this is really important too, because if one particular segment has significantly higher margins, in my opinion, why don't the management focus all their attention on that particular segment? Now, it does look like that maybe the debt ledger has slightly bigger or higher margins than the consumer lending. That's just based off United States and Australia, or the consumer lending, because even though the debt ledger purchasing in the United States revenue is a little bit lower than the consumer lending, it has higher profits. Now, not much higher profits, only by about $4 million, but it does seem like the higher margins are in the debt ledging. But I think maybe Credit Corp has gone down that consumer lending route just for some diversification. And maybe another reason they've gone down that route is it seems like consumer spending or consumer lending is growing at a little bit quicker rate than the debt ledger purchasing, just based off comparing the financial year 21 numbers to the financial year 22 numbers. However, all 3 operating segments did grow from last year to this year. Now to the valuation metrics for Credit Corp, and this is where it gets a little bit exciting, particularly if you think this is a high quality company. P/E ratio for Credit Corp, 14.6. That is in the low side, particularly when you look at the historical ranges of the P/E ratio for this company. Price to sales ratio, 3.4. That is also on the low side. There is no price to operating cash flow because this company was operating cash flow negative. Well, there would be a price to operating cash flow, but it would be negative. So when it is negative, I don't look at that sort of valuation metric. Also did a reverse DCF based off the earnings per share, not the operating or free cash flow, because again, that was negative. And to justify the current valuation, this company would only have to grow at 6% per year. And I think that this company can definitely grow at that rate. So again, there could be some value with this company right now, particularly if you don't go into a really hard recession in the United States, maybe just a mild recession in Australia. Now could be the time to take a position in this company. Maybe the share price of Credit Corp has reached its bottom. Now, when Credit Corp did release their financial year 22 results, the market did not like it. Now, in saying it did not like it, I think the market didn't like their financial year 22 results because of the outlook for financial year 23. No significant growth mentioned here. So ledger investment 220 to 260 million, net lending 50 to 60 million, profit between 90 and 97 million, earnings per share between 133 and 143 cents. So I think one of the reasons why the share price might have dropped when they did release their results is because of this financial year 23 guidance. Now to the daily chart for Credit Corp, and this daily chart is more important if you have the opinion that Credit Corp is a low quality company, and then it's all about the trend. And if you see a really nice trend developing in the share price, some positive sentiment behind the business, that would be the time to take a short to medium term position in the company, maybe even a long term position in the company, and hold it for as long as the economy is nice and sweet. And it's really interesting that right now the share price is at a pretty good, nice little strong resistance level. And that resistance level is exactly the 100-day moving average. The last time the share price got to the 100-day moving average was a day before the company released their financial year results. And then the next day, or the day they released their financial year results, the share price fell about 5.4%. Now, at one point in time, the share price was down about 10% because of the results and because of that outlook. And that really stopped that nice little uptrend in the share price from moving any higher. That was sort of the catalyst for the share price moving down from then. And then the share price went from that level, about $21, $22, all the way down to a low of $16.50, which was reached at the start of November. And the share price has rebounded over the last 3 weeks, and right now we are at that resistance level. I do expect possibility that we see another update for Credit Corp on the Monday, but moving past that, who absolutely knows? Because no one has any idea what's happening with interest rates, inflation, the economies. A lot of people have conjectures, have opinions about it, but no one absolutely knows. So I'm not going to tell you what I think what's going to happen in the future, because I have absolutely no idea. And the way you get around that is just by looking at charts, looking at the overall sentiment in the share price of Credit Corp, having looked at the overall sentiment in, say, copper or gold, in bond yields, that sort of thing. So right now, Credit Corp share price is still in a downtrend, but the last 3 weeks have been positive. Friday, the 11th of November, was positive. Share price was up over 10% in one day, and that's a really good day, particularly for those shareholders who have been struggling, who have been a little bit thinking maybe this is not the company to be holding at this point in the cycle. I plan on continuing this series for a while yet, maybe up until February, because February is when we start to see half-year results, and even some companies will release their yearly results in February. But the next 5 companies I will be featuring include Objective. That's going to be my next video. I've already prepared that video. Maya, SRG Global, which is a request, Australian Clinical Labs, and Domino's Pizza. If you do have a suggestion on a company you'd like me to do a video on, I'll leave that suggestion in the comment section of this video. Preferably, I like to do a video on a company that has pretty good revenue, is profitable, has a little bit of growth, preferably doesn't really necessarily need growth, because Maya has been one company that has seen its revenue really dive over the past decade or so. But I definitely don't want story or concept stocks, companies that have no revenue, because the whole point of me doing these videos is look at the financial statements, look at the historical financial statements or financial numbers for a company, and work out if there's any value. Also look at the chart. And when you're talking about value or concept stocks, they have no fundamentals at all, zero fundamentals. I actually get a little bit upset when people start to say, oh, this company has great fundamentals, yet they have no revenue, no cash flows, nothing. That is not the definition of fundamentals. A concept or story stock has zero fundamentals. It's all about the story. It's all about the concept. So leave those videos to other people to delve into. That's all I have for this video looking at Credit Corp Group's financial year 22 results. If you have any thoughts about this company, if you're very bullish about Credit Corp, I'd love to hear your opinion. If you're very bearish on Credit Corp, I'd love to hear your opinion because I want to get both sides of the story. So leave those opinions in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.